Bitcoin, Tesla, Supermicro. We're going to talk about all three of those. Let's keep Bitcoin simple. The order book at 90,000 was just cleared, which means you don't have that many sells left. It's one of the reasons why not only have we been holding 90,000, even through the geopolitical turmoil that we saw this morning. You noticed during pre-market, Bitcoin held pretty stable. But once you clear the 90K psychological threshold of people selling before 100 because they are actually skeptical that it's going to get to 100, it's going to get to 100. Next stop's about 102. Now, that might be bullish for now. But what I want to talk about in this video is not the long-term trajectory of what happens with blockchain technology or crypto, Bitcoin, whatever, but rather why I just purchased Supermicro and Tesla. Both of these require an explanation. In the meantime, it's worth noting that Bitcoin's probably going to struggle once it gets to 100K because a lot of people are going to take tendies around that 3-digit figure. Psychological reasons. Bragging rights, if it goes down, you'd be able to say, we sold at 3 digits. It's human psychology. Now, what's worth remembering is that doesn't mean we won't further exceed 102. That's all going to come down to the economy and macro, which is less about what this video is about. Though Supermicro and Tesla are going to have some economic issues related to recession as well, which I'm going to talk about hedging towards the end of the video, which will apply to Bitcoin as well. So if you're looking for a Bitcoin hedge, just because it is a risk asset and it's not going to do very well in a recession, if there's a recession, I hope there's no recession. Knock on wood. But let's talk Supermicro. I guess if there's one more thing to say, MicroStrategy will moon even more when Bitcoin hits 102. But again, you get to recession, their break-even's probably somewhere in the low 40s with how much they keep buying. You could potentially have some debt issues. So I'd be a little more careful with how much debt Micro is issuing. MicroStrategy, that is. But hey, Michael Saylor's obviously done a great job. So let's talk about Supermicro first. A lot of people look at this play and they say, Kevin, why would you buy Supermicro yesterday, which just happened to be the day before they chose a new auditor? Well, mostly because of the fundamentals and what securities analysis tells us. See, what's interesting is if you read the book Securities Analysis, they specifically refer to how companies can become cigar butt stocks, which would be stocks that sell below their intrinsic value because of accounting-related issues. See, accounting is really difficult. It's tedious, but not only is it tedious, it's difficult because you have to know how one action affects another, dual entry accounting, and getting good bookkeepers and accountants isn't the easiest thing. So, I'm not trying to put a pass on Supermicro, but I have a feeling that in 5 years from now, nobody's going to remember this accounting issue. And if you've been listening to what I've been saying either on my morning live streams, which are free to attend, the course member live streams, which you have to be a course member for, or just even in the Alpha report, which is also free, you can go to meetkevin.com/alpha and sign up for that. I've been saying that I think the Supermicro issue is overblown, and that even if you account for $200 million of fines, penalties, lawsuits, fraud allegations, whatever, this company's in a great spot. Just listen to some of these numbers and you'll see why I think there's such an opportunity. Of course, this video is not personalized advice, and with that out of the way, let's get into it. This company's down 81% from peak. Now, sometimes when a company is down so much from peak, it's because they suck. The problem with this company is that they're sucking because of negative momentum enhanced by filing their financials late. Yes, that's a problem. It is a very bad problem, and it's going to take cleanup, it's going to take work, and there are probably going to be fines and penalties. But it'll get cleaned up. Not only do I think it'll get cleaned up, but I think now the microscope is literally on Supermicro to where everything has to be perfect going forward. So I kind of feel like you're digging them out of a hole. I see it as sort of like buying real estate below market value. You're buying the crappiest home possible in a great neighborhood, and everybody else walks through and they're like, this has so many problems. Right. But the people who come in to fix those problems, knowing that now we've been priced to absurdity, and you'll see that valuation of absurdity in just a moment, they're the ones who get rewarded by doing the work or taking the risk. And you're going to see the fundamentals in just a moment. But I want you to think about that. I actually posted a house hack renovation video yesterday. You're welcome to see that. Great neighborhood, next to a guy with Tesla super, wall chargers and everything. But what's remarkable is if you look at this, this is just an in progress one, but just take a look. Here's this is what it was. Look how nasty this is. I mean, it's just a nasty, nasty property. And you turn that into kind of where it is now, and it's still in renovation, mind you, but I'm just saying, to me, wedge deals exist in stocks as well. We call them cigar butts, kind of like the, Charlie Munger, Benjamin Graham, and Warren Buffett days. So I'm a nut for cheap stuff when everybody else is panicking. In fact, I'm kind of known for doing the opposite of what the markets are doing, and that doesn't always do well for you. See, in fairness, I got bullish on bonds way too early. Like, July, August, not a great time to get bullish on long bonds because unfortunately they've kind of gone down quite a bit. Well, they're having a green day today, but let's be real, you're just getting a little bit back. I'll talk about why I'm even more bullish on those now in just a moment, but let's finish up on Supermicro. I like companies that are in trash sentiment, and I also like any kind of investment that has the worst sentiment possible because I have what I call a 2x2 formula when I invest in things. For companies, the 2x2 formula is very simple. Are the fundamentals good? In other words, is it going to go bankrupt? Does it have pricing power in its space? Does it have negative sentiment? I want to buy when the sentiment is negative. And is the PEG ratio relatively low? All of these have their own fluidity. They're each like a little rubber band. But think about this for a moment for Supermicro. It's selling for less than a 1 peg. It's selling down 81% from peak, and it's selling for 8 times earnings. You have a company that basically builds out the infrastructure for the NVIDIA Blackwell chips. They do super, water cooling basically as well. They've got water cooling stacks. So does Dell. Competitors have them as well, but this will be especially important with some of these higher performance chips, which gives them some form of pricing power. Building server racks isn't the highest margin industry. It's a 5 to 10% margin business to the bottom line, best case scenario. Whereas Apple's like a 25 or Microsoft's like a 35, NVIDIA's like, also like a 35. So they're definitely higher margin businesses, but from a server rack point of view, these are what your margins are, and within the industry, they're pretty competitive. People like using Supermicro computer. They're selling for 8 times earnings. That is extremely low for an AI adjacent. Well, it's more than AI adjacent. It is like, you can install AI servers without server racks. I still think there is likely to be a commoditization of LLMs and that there's some form of artificial intelligence bubble, but we've already kind of seen some of that bursting, or at least the trajectory of some of the valuations of these companies really chillaxing. Look, for example, at an ARM, this is your risk architecture, and you've peaked out. You've got a head and shoulders pattern here, like a 5-year-old can see this. It's not good. You might be going back to $46 if this head and shoulders plays out. You look at something like an AMD, you're on a downtrend, and you've been on a downtrend, frankly, since March. One of the ones even Meta. Look at Meta. You're down 10% from peak, which, look, it's done great. It's on a fantastic trajectory, and we're about to bounce off this trend line here, as well as this upper fib. But some of the euphoria has really left the AI space, and I think that is in part creating an opportunity for Supermicro. This company has enough cash and accounts receivable to pay off all of their current liabilities, long-term liabilities, including convertible bonds, and still have $4 billion worth of free and clear inventory as of March 31st, right? Obviously, all of this could have an asterisk on it, and we're going to talk Tesla in just a moment, because some people just aren't going to believe the fundamentals and the financials that were provided because, well, they're going through accounting problems. I'm including in this debt payoff deferred revenues as debt of just over $200 million, and I'm calling that my slush fund for, oops, we screwed up, we're going to get fined, and we're going to get sued. I'm putting $200 million in there. So I'm giving myself a little bit of that margin of safety, and I still get $4 billion of inventory on top of that. This is trading for about $15 billion as a company. And what's worth noting is if you annualize out your revenues for Q1, you multiply that by 4, you're sitting about $19.6 billion of revenues. It might not always stay that high. I'm sure it'll level off as AI becomes more ubiquitous. But I think there's a squeeze to be had on this play, especially as the shorts get out. Now, if you look at a PEG ratio, which is a price to earnings growth ratio, I like to be under 1.67 for any kind of hardware or manufacturing play. I would put them at about a 1.67. And if I put them at 1.67 on a PEG ratio, and I take a forward earnings projection of about $5 in 2027, then what I'll do is I'll take 5, I'll multiply it by 1.67, and I'm going to give them a 10% growth rate, which is honestly nominal on EPS. I think very achievable. That puts me at a price target in 2027 of $83.5. Okay, divided by where Supermicro's trading now at $28, it's about a 3x. So that is what I see as a present-day cigar butt play. Is there downside risk? Could they get delisted? Could they truly be the biggest frauds ever? Sure. And that gives it some downside risk. And then you can buy the dip on it if you believe they're going to be able to turn it around. But I don't think they're going to disappear, especially at this valuation. I think I've got a lot of cushion here. So that's a little bit on Supermicro. The numbers are great. So think about that for a moment. At least financially, with a $200 million asterisk, which I've already accounted for as margin of safety, I think you're good. That's part 1 of your 2x2. I think of like a Rust 2x2 foundation, right? Part 1, you're good. Pricing power relative within the industry, water cooling, great. As far as valuation, trading for less than a 1 peg, frankly, they're selling for less than 1 times annual sales. That's amazing. And then, of course, sentiment. I want it to be in the toilet. It could not be more in the toilet. Perfect time to buy. 2x2, check. Now, before I talk about Tesla, I just want to talk about hedges because this leads into Tesla. I believe that there are 3 primary hedges that we're going to have for this deflationary recession whenever it comes. I don't know when it's going to come. I really have no idea. But there are 3 primary hedges. The first hedge you should know by now is bonds and cash. I think 20 and 30-year bonds are going to perform exceptionally well as we go into a deflationary cycle. And I have options on the 20-year, for example, via TLT. I also have exposure to TMF. So I'm biased, but you have to, don't say, like I always say to folks, don't ask why somebody is saying, oh yeah, I'm bullish bonds. Oh, they must be bullish bonds because they hold bonds. You should ask yourself, why did they go bullish bonds in the first place? Well, quick TLDR, I think we are going to walk into an unemployment recession as soon as potentially next year, probably Q1. I could be wrong. I hope I'm wrong because it's going to cause a tremendous amount of human suffering. I don't think this is a real estate related bubble. This will be more of a valuation related bubble. And just the lack of liquidity and then layoffs and then, declining sales for a few years. I think we are very clearly in a slowing economic cycle. And as a result, I think there will be a lot of stimulus to try to promote demand. You're going to try to promote the demand side again, not the supply side. The supply side is built out. That's what the Fed affects anyways, the demand side. So we'll get back to the money printer. Except the money printer is not going to create a lot of inflation this time because we're not going to be sending stimulus checks. There's no way Republicans are going to fall for that again. Instead, we'll be printing, easing money through the Federal Reserve, which really benefits asset holders like, frankly, HouseHack, who has free and clear real estate, which I don't think there's a real estate bubble, so that's why we're buying real estate. free and clear real estate that I could then piggy bank open with some cheaper debt and go buy even more real estate. So we're really excited about that. Also, just sort of like side note, this morning in the Market Open live stream, I was serious when I said, it may have been the course member live stream, but I was talking about how my dream for house hack is to make it the Berkshire Hathaway of the future. That doesn't mean that I'm always going to be right in the short term or even in the long term. But it means that I'm going to follow my values, which is buying what I think is cheap and follows my 2x2 formula. And I'm going to do that same thing in real estate. And in the long term, the way I sort of see house hack developing is I think it's going to expand into not just buying real estate below market value, kind of like, in my opinion, you could buy a microcomputer at sort of a cigar butt valuation, wedge valuations, but ADU developments, larger developments, institutional funding, so our mini fund strategy, which we'll focus on in the longer term. But really, we also want to hold a lot of our real estate. Because really, I see house hack as a tax play. Think about the tax play of a corporation. C corporation, so you have lower taxes. If that corporation then has earnings that can be offset by real estate depreciation, you pay even less in taxes. And then let's say in the future, 20% of this company is it's sort of treasuries or it's cash or whatever, are invested into various different stocks through an ETF that company controls. It could basically long hold stocks, rebalance, and never pay taxes. Because just like in real estate, you can exchange and not pay taxes, you could do it with stocks. One stock runs, you can exchange to another stock. There's so many incredible things we can do with that company. So that is a big investment for me as well. And I just want more shares of the company. I'm putting more money in. It's because we have a fundraise going right now. That's at househack.com. You could read the PPM there, but we're basically giving you the right to buy shares and a 5% yield, which is pretty sick. And that's because we expect to be cash flow positive all of 2025, probably even Q4. We'll see if we can pull it off for Q4. And we're just growing. So it's really, really exciting. That's househack.com. But anyway, so TLT, bonds, cash. Fantastic. Cool thing is, if HouseHack has its own ETF, it could even move between bonds and cash tax-free. That's all in the future, though. For another hedge, I think mortgage companies are a hedge. Not as good as bonds, though. It's mostly because of mortgage debt. In certain areas, I think will be very desirable, especially for companies that service, since you'll also get exposure to those refinances as rates come down. And then the biggest hedge that I haven't talked about much, I've talked about in one prior video, for a recession is actually robotics. Finally we get towards Tesla. Yes, exactly. Now, Tesla's valuation has problems, and we're going to talk about that, but robotics is going to be the hedge of the next recession. Again, I don't know if that recession's in 27, 28, or when it is. But robotics, without a doubt, are going to be the way of the future. And you know how we went from no self-driving in cars to wow, really good self-driving in cars? The first 80% of neural nets is pretty easy to train. I'm not trying to minimize it, but you make the most progress with the least amount of cost. So I think you're going to get robots that are doing things decently, not great, but decently, very rapidly. That final 20%, much like trying to get a car from FSD 12 to full self-driving, robotaxi basically, that will take much longer. That could take, it could be 3 years to functional Optimus and then another 10 years to perfect Optimus. That's fine. But as we go into a deflationary recession, companies will unfortunately be forced to lower their costs by any means necessary. Robotics create a very interesting opportunity. See, robotics allow you to invest in a capital improvement. This is very important. That's why I'm talking taxes in this as well. By investing in a capital improvement, you're not actually expensing it to the bottom line year one. You're capitalizing it. Let me basically say this in English. If you have $100 of earnings and you spend $25 on a robot, I'm simplifying the numbers obviously, you might only expense $5 of that robot. So your earnings actually look higher because you're going to write that robot off over many years as a capital improvement. It's an asset. You're moving cash from one asset to another type of asset. Property, plant property, and equipment. Look at a cash flow statement, free cash flow, understand free cash flow, understand how accounting works. Robotics will be add back ins for adjusted EPS, in my opinion, because what do you do in adjusted EPS? You add back in depreciation. So all of a sudden, you're going to have companies like Amazon blowing money on robotics, cutting human labor, and they're actually growing their adjusted EPS by shifting from humans, which are an EPS cost, to robots, which are not. At least, depending on the depreciation schedule, most of it isn't. That's how companies are going to grow out of this next recession, in my opinion. More investment into robotics. So I'm working on a deal right now where I want to invest more in robotics. It's a private deal. I don't know. We're going through due diligence and underwriting now. And it's possible I'll be able to bring that to other people. So stay tuned. Make sure you subscribe to the channel. I will mention it in the alpha report. So if you don't want to watch every video or whatever, just go to meetkevin.com/alpha and let me know if you'd be interested in that. Basically, it'd be something like a venture capital kind of structure where we invest in various different robotics plays, or innovative technologies or whatever, not real estate in that. I cannot fundraise. I can't do a general solicitation for one company, so it'd be separated for various different companies. But I'm just saying, I'm going through due diligence on one company now. If this is something you're interested in, you want to kind of know more about this, or at least stay informed on what's going on, you could also email us at staff@meetkevin.com, and we'll let you know when we have more details on this. But Tesla's a robotics play. It's just very expensive as a robotics play, which is unfortunate. But I'm going to show you how it functionally could work. It's a $1 trillion company. I want to invest in robotics companies that are hundreds of millions to a few billion dollars, because I think they have I'm not making guarantees or projections, but I think they have 10x, 20x, 50x, 100x potentials. Very risky, obviously. I don't think Tesla has 100x potentially ever. There'll just be too much competition in the future, right? Does Tesla have a 2x in it? Sure. I remember when I said that I thought Tesla was going to double before NVIDIA doubled, and so far that's turning out to be true. That said, I have come to buy Tesla with a smaller allocation. I want Tesla to be a larger allocation because I actually think it'll sort of be like the Apple of the future, where people like Cathie Wood are like, cool, y'all have innovated so much, now you're a cash play. That's what I think Tesla's at some point going to turn into, when it's let's say a $5 trillion company or whatever. I don't know what time frame that's going to be in, but basically, unless something fundamentally and materially changes, I'm never going to sell Tesla again, my exposure to Tesla. And instead, what I'm kind of expecting is, while I think there's still a good run ahead of it, I do expect meaningful deterioration in a recession. And so I want to use profits that come from the hedge plays, the mortgage company plays, the bond plays, treasury bonds, 20, 30s, use those profits and throw them into buying the dip on companies like Tesla. Now, you could get the energy exposure pretty inexpensively through Enphase today. It's terrible sentiment, excellent fundamentals on the balance sheet, no bankruptcy risk, great cash flow. And it would be very stupid to get rid of the manufacturing tax credits for solar, because you would just send all the jobs back to Ukraine. It's Romania. Sorry. They've got pricing power within their industry, although they're competitive with Tesla, so it's not the best, but they do. And their valuation's one peg or lower. Tesla, though, we need to understand Tesla. Right now, Tesla prices out with its energy business and its, that's batteries mostly, and its vehicle business at probably about a 190 to 240 price. That's more fair. Now, that is up from where we were, a few months ago, where that was closer to 140 to 170, specifically because the trajectory of energy has exploded, and I think it will continue to do so. Larger mega packs. I also believe that a lot of the sort of limitation on incentives for U.S. manufacturing will stay, because otherwise you're basically raising taxes on American manufacturers, and that's very unpopular. Now, do I think the EV tax credit's going to go away? Yeah, sure, fine. That's going to be bad in the short term, but it's actually going to be great for Q4. Like, I have never seen this many people go to metkevin.com/Tesla and buy a Tesla. I personally think you can get better deals on a used Tesla right now. But boy, let me tell you, man, that freaking Cybertruck is sick. Dude, I go out there every day and I'm like, man, this is freaking cool. Why didn't I have this longer? It's nice. I feel like a little girl. It's like, oh, like my little babies. I just posted a little video reel of all 5 of the babies on X and Instagram if you want to see it. I'm Meet Kevin on Instagram and @RealMeetKevin on X. So I'll try to post some more videos too. And you can also see the Cybertruck and the plane. Okay, so if Tesla prices out between 190 to 240 now, that does mean we can revisit these levels, especially in a recession. I mean, everything's going to go down in a recession, except for bonds. I think bonds will actually do quite well in a recession. But the difference that you're paying today for Tesla at 340, that $100 that you're paying, so what is that? 100 divided by 342, 29% times 1,100. I'm paying about, I'm paying about $321 million for Tesla robotics exposure right now, which is very high. Now, they probably have the greatest opportunity for growth and mass manufacturing. Most robotics plays that I see, the biggest risk they have is that they do not mass manufacture. Google's going to, mark my words, Google will get into making their own robotics. Facebook, Amazon, all of them will probably get into their own robotics to compete with Tesla. Netflix is going to start getting into robotics to fix their streaming issues. Okay, that's just a jab. I'm joking there. But for sure, Google's, probably even Apple, they'll just be the last. And Apple will have theirs built in Foxconn. But, China. Well, we'll see how that goes with Trump. But then again, last time, Apple got some exemptions from Trump tariffs because, and then they gave him a nice new iMac or some kind of Apple. You can Google that story. Anyway, so it is a rich valuation. But Tesla, let's be real. They have the best pricing power of any vehicle company that exists. They have the biggest PP that exists. We all know that, which is great. We know they're not going bankrupt, which is also great. But the other two suck. Sentiment is way too euphoric. And you probably just had a short squeeze, which contributes to the euphoria. And the valuation is high right now. So why did I buy any of it? Well, frankly, it also serves as an upside hedge. So one way you could do this is you establish a smaller position than you want. I want Tesla to be a 20-ish, maybe 25% exposure. So I plant the seed at, let's say, 4 or 5%. If this just goes loony, because, the market can do crazy things, maybe it'll grow to 10, 15, 20% as an allocation without me doing anything. Perfect. It's like planting a seed. I don't think that's going to happen. So I'm prepared, first of all, to never sell those shares, A, because that's stupid. Don't bet against Tesla. I can admit mistakes. Number 2, buy the crap out of the dips. And the way that I'm hedging with bonds, I think will give me more capital to buy those dips. So, I'm also working on a build out of sort of balancing what I call this Trump Meet Kevin barbell. Stocks that I think will do, not stocks that have already fully priced in this expectation, but stocks that I think will do well in 2025, but also with a mix of Kevin's opinion of what's going to happen in 2025. So you get the Trump-Kevin barbell. You know, we're gonna see which PP. Okay, no, we're not gonna go there. Thank you so much for watching. Make sure you sign up at the Alpha Report. All the updates related to me, even I'll put little notes about the robotics or VC or whatever, all in this Alpha Report. I'll just put them towards the bottom, or I'll figure it out. Okay. I just want to provide value to that Alpha Report every day. I'm working on adding even more. So if you want to get that for free, go to mekevin.com/alpha, sign up for free. You get a text, email. It's an easy way to stay in touch to where you don't feel like you have to watch every single minute of every video. Obviously, I would love if you did that. I specifically would love if you went and watched my pilot video and, I don't know, let me know what you think about it. Anyway, thank you so much for being here. Cheers. Nice coffee. Still sober.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.